Chapter 11, Section 3, the stock market. In this section, we will talk about the ins and outs of the stock market, what stock looks like, where is stock sold, and how does the whole operation work in itself. So in this section, we'll answer the question, how does the stock market work? So let's first start with what is stock. Stock is nothing more than a partial ownership in a corporation. So when a company goes public, what that means is that now anyone is able to buy a portion or a share of a part of a company. So for this example here, let's say that Google has gone public and they want to sell stock. And by doing so, they can offer different shares. So for this example, we would say that Google has 10 stocks available, or 10 shares that are available. So that means if you purchase one of these stocks, one of these shares, you are now 1/10 owner of Google. So the more shares that you own, the more ownership you have of the company. So a stock is partial ownership in a corporation. And you purchase shares, and the more shares you have, the larger portion of ownership you have in that company. Now there's something called a dividend. And this is one of the ways you make money on your stocks. So usually, each quarter of a corporation, they come out with a report. And they come out with an amount of money, how much profit that they've made. If you buy stock into a company that offers a dividend, this means the profit that was earned over the last quarter is divided amongst all the stockholders, the shareholders. So for our Google example here still, if we had $10,000 in dividends that was made over this last quarter, we would take that $10,000, divide it amongst the 10 stocks, the 10 shares that are out there, and as a result of that, every person of one of these stocks would get $1,000 per share. So a dividend is profit made by the company during that quarter. Now we have something called a capital gain and a capital loss. Now, this is the other way that you're able to make money on your stocks. Now, a capital gain basically means that the price that you purchased your stock has increased. So let's say you purchased a stock for $50, purchased a share for $50, and at the end of the quarter, the worth of it is now $60. You would have a capital gain of $10. But on the flip side of that, let's say you bought it for $50 and at the end of the quarter, it's down $20. So we would consider that a capital loss. So capital gain, the stock price has increased. Capital loss, it has decreased. There are two different types of stock options. There's an income stock that pays out dividends, and the other stock option is known as a growth stock. And the difference between the two is income will pay out dividends, growth does not. So then you ask, how does a growth stock make its money? So at the end of the quarter, if a company has made money, let's say the $40,000, instead of giving that back to the shareholders to pay them dividends, what they do is they take that money and they reinvest it. And by doing that, the whole idea is that now that's $40,000 can now be reinvested in the company. And by doing that, now your stock is going to increase because growth is taking place. So when growth takes place, that means your stock value is going to be a capital gain, which we looked at the last slide. It's going to increase. There are different types of stock. There is a common stock and a preferred stock as well. Common stock says that voting owners of the company, one vote per stock. And what that means is that what we looked at in a previous chapter, a board of directors is hired by stockholders. And the stockholders are the ones responsible for hiring the professionals, which is the board of directors. So when it talks about that one vote, that's what it's referring to. That is having a voice in who directs the company. Now, preferred stock has no non-voting owners, but gets dividends before common stock owners. So, in this situation, you don't have a say on the direction, but any profit made is your first priority. You would get that first. Now, if a company is not doing very well and they go bankrupt, well, then the money that is liquidated for that company would first go to the bondholders and then the preferred stock, and then if there's anything left after that, would go to the common stockholders. Now, sometimes a stock split will take place. This is where a stock is reached a price where it's too expensive for the average investor. So what the company would do is actually split all the stocks. So for this example, let's say that the stock price started at $5 and dramatically it increased over the last 3 years. It's now worth $100. And let's say that price is just too high that the corporation wants to drop it. So what they'll do, if you're a stockholder of $100 and they say we're going to split it, you are now the owner of two $50 stocks. So it's to your benefit because now you can trade out, you can sell off some of your stocks and still have the same amount of ownership you had before. So it's a nice option for the investors, the shareholders. So where's the law of demand and law of supply in all this? If there's more sellers than buyers, there's a surplus. If there's more buyers than sellers, it's a shortage. Whenever there's a surplus of a stock in a company, that probably means the company's not doing very well, and as a result of that, they have to sell their stock at a discounted price, a cheaper price, because no one wants it at the current price. Just as you would find a product in the store in the clearance aisle, same thing with stocks. On the flip side, the shortage. If a company is doing real hot and they're growing really quickly, we would have more buyers than sellers, so now the price is going to have to increase because everyone wants that stock. All right, so how do you actually trade stocks? Well, most people, you can independently go through a website, sign up for an account, and publicly trade through a company. Or you can go through a physical person and a real place, and at this real firm, you would have a brokerage firm. And the brokerage firm is the one responsible who specializes in trading stocks. And there's stockbrokers that work for the brokerage firm. So you'd go to the brokerage firm, they would assign you a stockbroker who would then be the one responsible to help buy and sell your stocks for you. A lot of times you can just give a percent of your paycheck goes directly into this and you don't have to worry about anything else. Others like to be heavily invested and know what's going on. So how do these guys make their money? One, there's a commission. Anything that they make, you make, there's usually a percentage involved. Second, there's a fee. Every time you ask them to buy or sell our stock, there's usually a transaction fee. And third, sometimes they can buy wholesale stock and resell it at a higher price. So let's say they're able to buy 1,000 shares at $1. Maybe they're going to flip them and sell them for $3 each. So commission, a fee, or they can sell low or buy low and sell high. All right, where do we find that stocks are actually traded? Well, we have a stock exchange. This is where it's a market of buyers and sellers. Just as we looked in microeconomics, of buyers and sellers coming together, stock exchange is no different. The largest and most powerful stock exchange on the planet is the New York Stock Exchange. It's a big deal. This is where you find a lot of blue chip companies. And what that means is these companies are well established. They've been around for a long time and they're not going anywhere. They're usually a safe bet. And this is where you find these blue chip companies that are being traded there. And then we have the NASDAQ. The NASDAQ is the largest electronic market for stocks. So instead of it being traded on a physical floor, it is now electronically traded. And this is where a lot of people can buy and sell stock on their own using the NASDAQ. Kind of interesting fact about the New York Stock Exchange is it actually began in 1792 and actually started outside, and there was restricted seating and seats had to be purchased in order to be there, and obviously they moved it indoors since that time, but it did start outside. The NASDAQ idea started in 1971. 1990s, it really took off. New technology stocks began to fly out the door. Anything with the .com behind it went extremely fast on the NASDAQ. All right, so stock options. There's a couple of different things here, and I'm going to provide another instructional video just for this slide so you have a great understanding of what these are. So the futures and options. This is, in a nutshell, this is how people try to learn the stock market. They try to beat the system. They try to buy really low now at a set price, and they anticipate that hopefully over the next 6 months to a year, the price on that item would increase. So futures is dealing with commodities. A commodity is a natural resource. So it could be cattle, it could be oil, natural gas, lumber, anything that would be considered a commodity, anything that's the same no matter what it is. And this is where futures are sold. They're buying and selling commodities. Their hope is that example, maybe wheat. Their hope is that they can lock into a price today that's very cheap, and then hopefully 6 to 12 months from now, that lower price, they'll buy it cheap that day and then be able to flip around and sell it right away. Options is the same thing, but this one's more selling stocks and other financial assets. You have a call option, which is a contract for buying stock, and a put option is a contract for selling stock. And as mentioned already, another video will be provided to explain these stock options. All right, there's also individuals who are day traders. This is usually people making dozens of transactions each day. It is not advised when it comes to day trading to go this route just because it's so risky. And the better way, obviously, to invest is to start young. It's to start putting a percentage away of your paycheck and let that grow on its own. Day trading most of the time is just trying to get an easy buck, and a lot of times, a lot of people lose more money. Now, there are those out there who have been very successful with day trading. I'm not saying they're not out there, but the percentages are so high of those who actually lose money that it's just not a best option for most of us. All right, stock performance. Now, if you heard in the news, sometimes they'll say we have a bull market going on, or this last quarter was bull market. What does that mean? A bull market represents a steady rise in the stock market. So when we went through a recession in 2006-07 to 2010, the stock market was dropping. And as a result of that, we were referring to that time period as a bear market. People were fearful. When fear is out there for the consumer, we tend not to invest as much because it's a higher risk. So a bull market means the economy is doing excellent, stocks are growing. A bear market means things are stagnant or stock market prices are dropping. And as a result of that, people are not going to invest as much. Bull market is a good market, bear market is a bad market. We also have measurement tools for the stock performances that are out there. We have the Dow Jones. Dow Jones is nothing more than a measurement tool of a stock performance of 30 different stocks in various industries. So it's just kind of like a sampling of how the stock market is doing. S&P is similar, but instead of 30, it's 500 instead. So what we find in these tools, usually in the news at night, the Dow Jones was up 30 points or S&P was down. It's just a measurement tool. It'll let you know how the performance was of the stock market for that day. All right, now let's talk briefly about what took place in 1929 and the stock market crash and the Great Depression. And how did this all come about? Well, in 1925, the market value of stocks was $27 million. And within 4 years, it jumped up to $87 billion. The Roaring Twenties, this was during that time frame. People were so heavily invested in the stock market that it was a win-win situation that everyone thought it's never going to fall. Economists during that time saying we were going to have another 10 years just like the 20s. So a lot of speculation and buying on the margin was taking place. Speculation basically means is borrowing money in hopes of getting bigger return. So let's say that you don't have the funds to invest in the stock market. So you go to the bank, you borrow $10,000, and you take that money and put it directly in the stock market. Well, the hope and the trend that was taking place in the 1920s is that my speculation is that this borrowed money of $10,000 will grow to $30,000 within so many months. And as a result of that, banks thought it was a good deal of, hey, they're going to borrow $10,000. Let's say we make $5,000 in interest. They make money, we make money. It's a great deal. The other thing that we found was buying on the margin. This is where investors could buy a stock for a partial of the price, borrow the rest from the brokerage firm. So instead of you taking on the huge burden of just investing or borrowing all the cash, you could take what you had to buy stock and then borrow the rest from a brokerage firm. So one was through usually a bank, the other one is a brokerage firm. Both are highly advised as not a wise decision to make. As a result, so we saw here October 1929, 87 million. We saw that was the end of the great Roaring Twenties. On October 23rd, Dow drops 21 points in an hour, which is unheard of. It was known as Black Tuesday. On October 29th, 16.4 million shares were sold. Fear broke out. People were trying to liquidate all their assets before they lost anything. It was one of the primary reasons for the Great Depression. Hoovervilles were towns built out of scraps. There were so many people homeless that you'd have these towns that were all around here. And as a result as well, people did not trust the stock market until the 1980s. Then we had the advancement of technology, the internet boom, and everyone was jumping in on a Roaring Twenties again. That it was a dot-com boom. Anything that company had a .com behind it was considered a great buy. And the last slide that we have here is what took place on 9/11, and Enron was a big part of this, and the housing market was the last big scandal that we had. This is the end of Chapter 11, Section 3.